not much has happened over the last 12 months, obviously, so this will be a very quick, boring presentation. We know what's going to happen in the world now. Now, this is, I was saying this is the 10th year we've done this here, and this is probably about the 12th year that we've been doing this global economic and risk outlook, and there has never been a year with more uncertainty going into it than this year, without question. There is a lot of uncertainty, not just here in the United States, but around the world, both politically and economically. If you haven't been here before, and if you don't know about ISA, we are we do two things. We publish economic research, country reports, risk forecast, and we provide advisory services for companies and business and governments that are operating internationally, whether they're exporting or investing in international markets. If you've been here before, you know the agenda. It hasn't really changed in 10 years. What we do is we look back at 2016, we look back at the year before to see why we are now where we are, what happened over the last 12 months to bring us there. Then we're going to look at some of the key political issues for 2017, key economic issues for 17, and then like always we're going to go region by region, looking around the world to see what the outlooks are for trade, investment, and economic growth. And then, of course, as always, we have time for a Q&A. So if you have any questions, save them up. There's a lot of information, a lot of charts in this presentation. Like was said, you're going to get a copy of it, so don't worry about if you miss something on a certain chart or not. So has anything happened over the last 12 months? Just a bit. One thing that's interesting, and I've said this before, typically when I do this presentation, the economics precedes the politics. Well, 2017 is a year where the politics are driving the economics here and around the world. So we're going to, on each of these sections, focus on the politics first and then on the economic impact. So some of the key issues, quite frankly, the election of Donald Trump was a surprise for much of the world. We gave him about a 25% chance of winning the election, which was rather generous compared to most other forecasters at the time. But he won. He won the election. He won the Electoral College quite handily, though he lost the popular vote by almost 3 million votes. That's had a major impact, of course. And Donald Trump is going to have a presence throughout most of this presentation, as you could expect. So I'm not going to dwell on what happened in November. We're going to actually look at what happened, what's going to happen in the months ahead. One of the key international issues that happened last year, and this was second only to the election of Donald Trump in terms of impact, was the fact that British voters, by a margin of 52 to 48, opted to leave the European Union. Now, this is a major development both for exporters and investors from the United States and around the world, because the European Union is one of our leading trading partners. Put it in this perspective. The impact of Britain leaving the European Union is kind of like the impact of California leaving the United States in terms of... I could have combined some other states, too. Does anyone have any other states you have something against? Michigan, Michigan, Wisconsin, Minnesota, we can get rid of them. Yeah. I see where this is going. Okay, well, we'll assume for a moment California left the United States. Britain accounts for about 20% of all the foreign investment that goes into Europe. It accounts for a lot of the foreign investment that goes from the United States into Europe. It accounts for about 18% of the European Union's economy. It's leaving now the European Union. This has caused great disruptions in terms of investment and trade in Europe, and it's going to cause even more because this is a lengthy process. They're only going to officially launch the process of leaving this spring, and it's going to take about 2 years until they're actually out. That means that the fastest growing economy in West Europe in recent years, the fastest growing large economy, is now leaving the European Union, and that's going to cause growth to slow both in the UK and in the Eurozone and in Europe, over the near term. So that's something we're going to talk about a little bit. The rise of populism. Populism takes a number of forms, both right-wing populism and left-wing populism. We're seeing this across the board around the world. On the right, you're seeing support for politicians and political parties that are against immigration, for protectionism. They're strong on security issues. And on the political left, you're seeing support for reductions in income inequality and more government involvement in social programs and things like that. This is causing a lot of disruptions. We've seen what happened in the United States presidential election, both on the right with Donald Trump and on the left with Bernie Sanders, who was probably the most successful far-left candidate the United States had since Franklin Roosevelt, quite frankly. So this is on both sides of the aisle. The middle, not only is the middle class economically shrinking, but the middle, in terms of voters, is also shrinking. Those are the 6 most important elections that took place last year. Some of them are presidential elections. You have a few referendums in there. What they all have in common is there was a shift to the political right in 2016. And if you've been here in the past, you've seen slides that showed there was a shift to the political left a number of years. But last year, unquestionably a shift to the political right across the board around the world. Politically, a lot of attention remains in the Middle East and North Africa. The 4 civil wars that are going on there, we've been talking about some of those for a number of years now. They're still going on. And the one country where a lot of people here in the United States are doing a lot of business, Turkey, also had a very difficult 2016. There was a failed coup attempt. There have been numerous terrorist attacks. This region continues to draw us in, a lot of attention being paid to it for a lot of negative reasons there, let's say. Okay, let's get to the economy. Let's say 2016 was the 5th now consecutive year, and you've seen the slide before. We've said 2nd consecutive year, 3rd consecutive. It's now the 5th consecutive year in which the global economy grew by just about 3%. We have clearly reached a new normal in terms of global economic growth, and that is 3%. Before the financial crisis, economic growth rates were about 5 to 6% per year on a pretty consistent basis. Now we're down to 3%. And what does that mean? That means for exporters or investors, it's increasingly difficult to find growth in international markets. You can find it, of course, but it's not as easy as it was a few years ago. And this is both due to slowdowns in developed economies, but also slowdowns in a lot of the key emerging markets that were providing a lot of growth in the past. If you think about 2010, 2011, about 70% of the additional growth for the global economy came from emerging markets. Right now, it's only about 50-50. A lot of emerging markets that were growing substantially in previous years are not anymore. And we'll talk about that a little bit later. Trade and investment, likewise, remain depressed. Global trade levels remain where they were, 7 years ago. We have not seen any increase in global trade. Global investment levels, after a bounce back in 2015, slowed again, it appears, in 2016. And now with all of this talk about protectionism, about trade barriers, a lot of businesses are very hesitant to make major commitments to trade and investment at this point. So what about here in the United States? Well, 2016 started pretty badly. The first half of the year was pretty bad. That was due a lot to a lack of business confidence. Businesses were not spending money in the first 6 months of this year. Now that turned around in the 3rd quarter. We had a major increase in growth in the 3rd quarter. The 4th quarter looks like it'll be fairly robust. But overall, again, we're looking at the 11th consecutive year now here in the United States where growth did not reach 3%. That never happened in the history of the United States going back to the 18th century. We never had a period where we never managed to reach 1 year at least of 3% growth. Not during the Depression, not during the Civil War period. Never in our history have we had such a long period of relatively sluggish growth. If you look at that chart, this chart on the bottom there is pretty interesting. That shows average growth by decade. So if you think about your grandparents' generation, look how fast the economy was growing then, about 4.5% per year. Then if you look at your parents' generation, well, it was growing about 3% per year. What about our generation? The economy over the last 20 years has averaged just 2% growth per year. And there's a number of reasons for that. The population growth has slowed. The benefits of globalization have been reduced. So we're looking at the lowest growth. We're the generation that's facing the lowest growth in the history of this economy. And it's not just here in the United States. This is the same around the world in terms of developed economies. Of course, Donald Trump's victory had a major impact on the markets. The Dow is up above 20,000. That's due in large part because there's a lot of hope that a lot of this money, this over $1 trillion that corporations have stashed overseas, some of that's going to come home. There's talk of a $200 billion investment fund for infrastructure. That's a great idea. I support that idea 100%. If it's done properly. Will they set up a national board to oversee this, or will they allocate the money to states or to localities? We don't know yet. There's been very little said about what will actually happen. But if $200 billion is pumped into our infrastructure, absolutely. It's an absolute win. We'll get back to the United States later. Let's look at what's happening in Europe. Europe's a similar situation. Growth is even lower over there. It peaked at about 2% in 2015. It slowed a little bit last year. A lot of the growth in Europe's been driven by economies on the periphery, economies like Britain, economies like Spain, Poland. Each one of those is forecast to slow in the coming year. So this is going to be a challenge for Europe. How do we maintain this recovery with some of our key growth markets starting to slow? The one positive for Europe, a negative if you're an American exporter, is that the euro and the pound now as well are very cheap. And these are export-driven economies, so they need a weaker currency. We've been calling for years that those currencies be weak, and they finally are where we think they should be. China, here's a talk about alternative facts. The Chinese economy officially grew by 6.7% last year. In reality, it grew probably about 4%. In 2015, it grew probably about 3.5%. If you look at things like electricity usage, freight traffic, you can come up with a pretty clear picture of what the real growth number is in China. But if you've been here before, you know they don't always exaggerate in China. Sometimes they've actually reported a lower than actual growth number. They want to show that they're in command of the economy, that they don't have the peaks and valleys that economies like the United States and others have. Some risk levels in China are growing substantially. And debt, as I gave away there, is the key one. Private sector debt levels in China are growing through the roof right now. And this is a major threat to the country's banking system. There's a lot of bad debts on the book in China. This is a major issue because China's retail market, consumer spending, it's growing by 10%, 11% per year. This is becoming an increasingly important market for US exporters and US investors. We need the Chinese market to grow. We're talking about protectionism now with China. That would have been great 20 years ago when they weren't buying anything from us and just exporting here. China's buying a lot more from us and will continue to do so in the years ahead as their market continues to grow. So the talk of protectionism, it might have been a little bit late. India is now the fastest growing large economy in the world. It's growing, it peaked at almost 8%. Now they controversially pulled their two most important banknotes out of circulation, that's what I'm trying to say, last year. And that's going to cause a little dip in growth in early 2017, but nevertheless, the Indian economy is now on its way to being consistently the fastest growing large economy in the world. Now keep in mind, India's population is growing rapidly as well. China's population is not growing at all. I mean, the working age and consumer age population in China is now peaking. But in India, it's still growing, so they need to generate even more growth than China in order to reduce poverty levels. India's economy, keep in mind, is just the size of Italy. It's just a little bit bigger than Italy, so its impact on the world isn't quite that big yet. It's got a long way to go before it emulates China. Outside of Asia, it's been a much more difficult couple of years for emerging markets. I mean, you look at some of the numbers coming out of Latin America and East Europe, they're very depressing. The Brazilian economy has shrunk 2 consecutive years by nearly 4% per year. Venezuela, we've talked about them. In the past, we've compared their government to the Cleveland Browns administration. Well, they have something in common. The Browns had their worst year ever, and the Venezuelan economy had its worst year ever last year. It shrunk by 19% last year. And the inflation rate in Venezuela this year is forecast to reach 2,000%. So your currencies there will be pretty much worthless. This was the richest country in Latin America not that long ago. And by some measures, they sit on the largest oil reserves in the world. So and this is a story, this goes on. A lot of emerging markets have been hit hard. If you're dependent upon commodity exports and you've seen the price of oil stay low and you've seen other commodities price stay low, of course you're going to get hit. And a lot of these countries haven't developed their export competitiveness to the level of countries like China and Vietnam. This is certainly something that if you're an exporter right here, you're dealing with. It's the strong US dollar. The US dollar over the last 3 years has been the unquestioned strongest currency in the world. The chart on the upper right shows the change against the US dollar for certain currencies over the last year. A couple have rebounded, but not much. The more important one is the one on the bottom right. That shows the change in the exchange rate against the US dollar over the last 3 years. And look at some of our key trading partners, how much their currencies have depreciated against the US dollar. The Mexican peso, which who knows right now where the floor is for the Mexican peso. I mean, with all this talk coming out of Washington, there could be a continued drop in value in the peso as lack of confidence and a lack of investment in that economy takes place. But even developed economies like Canada and the Eurozone, their currencies are 25% down against the dollar. That's making their exports a lot more competitive than ours in the United States. Interestingly, the one currency that's not really that weak right now is the Chinese yuan, and that's the country we keep accusing of manipulating their currency. But the yuan is actually quite strong. China's lost also quite a bit of export competitiveness in recent years, both through a strong currency and through rising labor costs. This is, of course, an issue that impacts this part of the world very substantially, and that's the average oil price. Oil prices rose by about 20% at the end of 2016 when OPEC and some non-OPEC member states reached a deal on output cuts. It's a pretty fragile deal. First of all, the deal only covers the first 6 months of this year. The deal runs out at the end of June. And already some of the countries involved, Iran, Iraq, Algeria, are already making hints that they want to just break the terms of the deal and start pumping more oil. So if oil prices go up, of course, that means more wells here get tapped and more oil is going to be produced in this part of the world. But if the oil price doesn't gain any more momentum and starts to slide back down towards $40 a barrel again, that's unlikely to happen. We don't see that much upwards pressure on the price of oil. We don't think the deal will hold. If it does hold, it will barely hold and will not be renewed in the middle of 2017. And so that means oil prices are going to remain relatively stagnant at best. Demand as well is not going to be as high as some people or some companies are expecting. And that's had a huge impact on major oil producers in the world. Look at those budget deficits for some of the main oil producers. Some of those are very wealthy countries, Kuwait, Saudi Arabia. They're running 13, 14, 15% budget deficits because the oil price fell and their revenues fell substantially.